This podcast is brought to you by Ginsler Wealth. The information discussed today is meant to be general in nature and not tailored to your specific investing circumstances. This means that you should talk to your regular Ginsler Wealth advisor or your own advisor before acting on any information we discuss today. Nothing in this podcast is intended to be a solicitation, and past performance does not guarantee future returns. We're calling this the sexy episode of the Unlimited podcast because of my post-laryngitis voice. But don't worry, Som and I will keep things clean. Today on the Unlimited podcast, we speak with Som Seif, founder and chief executive officer of Purpose Unlimited. We talk about innovation in the wealth management space, industry first, and Som's key to success. Let's go. Well, welcome everybody to a new episode of the Unlimited podcast. You know, people always think that maybe the world revolves around them and everyone's always thinking about them all the time. And I truly don't believe that whatsoever about me and us. I don't think anyone's really thinking about us. But if you are, you may have noticed that it's been a little bit of a gap since our last podcast. And you may also have noticed already that my voice sounds a little bit off. I've had laryngitis for the last week or two, and with my guest here, we were supposed to record a little while back, and I had to reschedule because while I'm told I sounded very sexy, that wasn't the sort of sound that I was going for on the podcast. So here we are, we're back, and very excited to have a great guest with us today. We're going to talk about innovation in the wealth management sector or the wealth management space and a whole bunch of other things, which just happens to be some of my favorite topics and some of my favorite industries, I guess. So want to welcome Som Seif to our show today, and very much appreciate it. I'll give an intro in a second, but thanks for joining, Som.
Brian, it's great to be here, and you sound sexy always. So I think it's a wonderful that we got to delay it to get a little bit more sexy. So
Right, and you told me before we started you may have a little scratch in your throat, so this may be the sexy episode of
that's
the
right.
Unlimited
We're gonna
podcast.
promote the unlimited sexy episode.
Right. So let me give a quick intro, and some of our listeners, if you've been frequent flyers, you may recognize our guest. You may have seen him on your airplane TVs. Som is the founder and chief executive officer of Purpose Unlimited, which he formed following the sale of Claymore Investments to BlackRock in March of 2012, and the co-founder of Wealthsimple Technologies, known mostly as Wealthsimple. Prior to Claymore Investments, Som was an investment banker with RBC Capital Markets, and he has a strong commitment to community, currently the co-chair of the U of T Defy Gravity campaign, a member of the AGO Foundation Board and Next Canada Board. And in 2011, Som was recognized as one of Canada's top 40 under 40 by Caldwell Partners. That's the official bio. There'll be a little bit more in the show notes, but I also wanted to mention, very importantly for this episode, some of the financial and wealth innovations Som has been responsible for. And that includes, as I've described already, launching one of Canada's first major exchange-traded fund companies, launching Purpose, which we're going to learn a little bit about, co-founding Wealthsimple, which I've already mentioned, launching the world's first Bitcoin and Ethereum ETFs, which we're going to dive into because that was pretty amazing, and launching Canada's only, I think, non-pension, in quotes, pension fund for everyday Canadians. So really, this is a true not to toot your horn, but a true innovator in the Canadian and frankly global wealth management space. Again, Som, welcome again, and thanks. Look forward to hearing how you've done all this stuff.
Well, it's first off, thanks for again conversation. It's always uncomfortable when you hear people talk about your bios, but I'm always excited about the things that we are doing in the past, because I think all of it comes down to just like solving problems on behalf of Canadians. And it's a lot of fun, actually. I don't think of it as like, not just on a bedside. I just look at it as like, how can we ultimately really win and help, the market improve? How do we help Canadians ultimately succeed in achieving their goals? And these innovations come out of that ultimately.
Yeah, amazing. Well, let's get to the path of those innovations. And for listeners who have heard a few of these episodes, I always like to go right back to the beginning. So can you give a little bit of background, like, the superhero origin story, as they call it, if it was Marvel or DC Comics or something. Where are you from? When and why, and how did you get to Canada? What was your path to all the way through to what you're doing today? You don't have to take 2 hours to do, but the quick overview, I
The
guess.
quick Coles notes are, so I'm an immigrant to this country. I came here in, 79, 80. My parents made the greatest choice of my life. Ultimately, the greatest gift they gave me was to make the decision to come to Canada. And I'm a big, mathematics and probability guy, and that simple decision changed the course of my probability of outcome quite materially. And, there's a lot of history as to why they chose Canada, but, it was a progressive, growing country that, welcomed immigrants at the time, and it was very important. And, that was very foundational for me because, I love this country. I feel a debt of gratitude to what it has given me and my family, but more importantly, it's pushed me in many ways to give back in a meaningful way. My goals as an individual were always kind of very, similar to others. Like I just wanted to really make things happen and have a lot of fun. And I didn't come from wealth. My family created in this country a really nice middle class lifestyle for us, and gave us wonderful foundations. But I always had this ambition of wanting more, and that drove me all throughout my high school career and into university and onwards. And so, actually, when I was a young kid, I always wanted to be an architect. It was one of my dreams, ambitions. I actually, for I think 15 years, from the age of like 5, had always said architecture was a thing that was going to
Mm,
drive me. And then, right before I was making the final decision to which university to go to, which program to go to, and I had been accepted to architecture and engineering courses to undergrads. I went and met with a couple of architects, and the architects, I met with all told me that, "You shouldn't do this. This is a silly career profession. You're gonna it's gonna be a big grind. You're never gonna do the things you actually love, which is actually designing and developing beautiful buildings, and you're never gonna make any money." And, to me, that was a real sort of shock and concern because you had real people telling me that, and it scared me. So I made a decision to start with, engineering, went to U of T, studied engineering, and frankly, very quickly from there, made a decision that, okay, engineering is wonderful, but I think I wanna do something in business, and, that led to a thought process of, sort of a career planning and career sort of perspective of what are the things that are gonna excite me, where am I gonna learn the most, and that's all how I ultimately kind of built my career.
amazing. Good. Anytime someone says, "Want to be an architect," I think of George Costanza and Vandelay Industries, but we won't go there. It's always good to say that you're an architect, but I will say actually, when I was at Gluskin Chef, we moved from Brookfield Place or BCE Place to the new Bay Adelaide, and we had 50,000 square feet of concrete on the top two floors, and we hired KPMB architects. Probably, I don't know this industry very well, but probably the top, close to the top architects in the country, maybe the world, and designed the most beautiful place. Unfortunately, Gluskin Chef doesn't exist anymore. It was a great firm, and I will say no one there was crying over, their salaries or anything like that. But I will say the rate that the top architects in the world were charging relative to the rates we were paying for lawyers, accountants, and other things, it was a dramatic difference. And so I get your thought process there. Amazing people, amazing designers, amazing creativity, absolutely spectacular. It seemed like there was a big difference between what architects are earning and other professions. I don't know why.
Well it's funny 'cause, one of the best pieces of advice my mom gave me at the time, and I didn't listen, because I came back and talked to her about it, and she said, if you're passionate about something and you're good at it, you'll always find a way to make great money at it." And, I think that that's the point. I mean, look, at the end of the day, the great architects are great architects for a reason, and, that you could be a great anything and be passionate about it, and, that's really the value that you're gonna capture from it. So and I've learned a lot in my career. You should never, ever do anything in pursuit of money. You should
Right.
always do it because you're truly, something that will actually make you long-term happy, and default happy.
Yeah. Okay, so you made that switch, I guess, or in or thought process to move to the business world. I believe you started your career in investment banking at RBC. I started in investment banking at a firm called First Marathon Securities before it got bought by National Bank, and so on. So I know the business reasonably well, but can you describe your sort of start? And actually, and a lot of students every year, people want to and think they want to go into investment banking. When I went into investment banking and did the interviews, I almost faked my answers to questions because I had no clue in the world what the heck investment banking was during the interview process. And luckily, I got a job. But what was investment banking like? And obviously, you eventually changed. So maybe just a little color there. And
Yeah, no, so first of all, it's a very similar story. My everything I learned about investment banking was from a TV show called Traders, if you recall, in the late '90s, and it sort of sounded like a really cool job, so I kinda went after it. Look, RBC was a wonderful place to work. It was the biggest investment bank in Canada, at a time, that was really exciting. I joined right in, the middle of '99, right around the tail end of the, tech bubble, and it was an unbelievable experience. For the first 6, 9 months, I think I did more activity as a junior banker than I did for the next several years. But what I will say to you is that it was a grind. And one of the things that's been important and foundational in my career is I've always, whenever given the opportunity, whether it was engineering, whether it was, investment banking, whether it was a life of entrepreneurship, I've always chosen the hard path. I'll tell you, investment banking was one of the great foundational learning experiences. I was there for 6 years. For 6 years, you work effectively a double career. When I exited RBC, I had a 12-year foundational career of learning, of experiences that I had been built and networks that I had kind of, learned from and built relationships around. And the thing that was foundational though for me was, in about 2, 3 years, when I first entered investment banking, my first thinking was, "Oh, this is gonna be a great place to go and generate and make money," right? Because that's what was one of the things I thought was my goal. And, about 2 years into it, I actually had a little bit of a meltdown because I realized that, like, yeah, it was a place that I was making money, but I wasn't happy for that. That wasn't the reason why I wanted to do this. And, it was a very empty moment for me because, I was working like crazy. I was learning a ton, but something was not, driving me to be happy with this opportunity. And I had to sort of stop back. And I don't know if you ever saw this, Brian, when you were in your career at any point where you've actually said, look, I'm pursuing the wrong goals. And it was a moment to really reflect on what really mattered. And if I go back to my principle of why I wanted to be an architect, it wasn't about, yes, I love design, I love buildings, but it was always this pursuit of progress, of seeing the things and the ideas that I had ultimately come to fruition and see that I'd accomplished something of real value. And so when I looked at this, I said, this is what really makes me skip to work on Monday mornings. I still was having fun in investment banking, but I needed to know that I was going to do something different over time. And one of the things that drove me there was, I looked up and I said, whose job in this company do I want at the age of 45? Like who do I admire to be like their life? Like, and I couldn't find one person that
mm,
was a senior banker that I said, I want that job.
yeah,
And I said, okay, that's my indication I gotta leave. And, but it was an unbelievable learning experience. I mean, I'll tell you, for any young person, you want to, have a massive amount of every part of an early stage of a career benefit of learning, people, engagement, projects, capital markets experiences, strategy, everything all, call it squeezed into a very tight bucket. It's an unbelievable experience, but it's hard. I saw so many people join investment banking coming out of their MBA or their undergrad in BCom and within, 30, 60, 90 days actually quit because
mm,
all through their undergrad, it was investment banking was a thing to do. But then, so they were doing it because that's what they were told to do. And then when they got there, they said, this isn't really for me. And that's the worst outcome because you just spent 4 years or 2 years doing a degree. You go through the networking cycles and you chose a career path that ultimately was wrong for you for the wrong reasons. So, what I always tell people is it's an unbelievable experience, but you got to know what you're getting into and you got to do it for the right reasons, which is, and for me, it was all about consumption of learning, consumption of foundations of my career, that really, call it catapulted me to my next stage.
yeah, yeah. I had a similar experience as well. I realized about 4 years in, I stopped halfway through, did an MBA, came back another couple years. I realized 4 years in, similar to you, there wasn't the path there that I wanted to take, and it was the wealth management area that I wanted to move to, which I did. But I agree, huge learning, and in particular, I would say for me, I don't know what for you, a skill that you'll have forever, attention to detail. because you're putting together these huge decks and you're doing it at, 1 in the morning for the next day. You can barely see straight. You gotta be really thorough. And
Every first year, second year analyst knows that the most common critique is attention to detail.
yeah,
And it's like, because what you're doing is you're working 80 to 100-hour weeks. You are, tired. You're, in
yeah,
every way possible. You can hardly stop and think, but you're expected to deliver, really deep quality. And the transition from first year, second year to third year is actually the hardest because in first year and second year, there's always someone who's overseeing what you do and someone who's going to, check your work. When you get into second and third year, that's the year when actually your work goes direct to the client.
right.
And so the stress and the extra kind of level, plus you're still working those extra hours, the crazy hours. And so it's a level of, call it, stepping up that is required of you. And it was really amazing. One of the things I pursued through it was, I didn't just wait for people to come to me with kind of, here's the projects. Of course, that's what you're, as a young junior banker, you're constantly being told, here's the projects we're working on.
Yep.
But what I tried to take a pursuit of was, how do I take my ideas and share them with others? So I would, often pitch ideas to the managing directors to go to customers with, to, target opportunities. And look, at the end of the day, some of my ideas were really stupid. I still have some of those old memos I put together. But it kind of built my muscle of wanting to sort of say, I'm going to take a little more control of this, identity I'm going to create and this opportunity that I'm going to create. And it built a relationship with the MDs that they would actually critique the ideas and give me good feedback. And they looked at me slightly differently as a result of that.
Yeah. Yeah. Actually, similar. Did the same as well. And that's sort of how you differentiate yourself and potentially move up. But let's talk about, so then you've decided it's time to move on because of what you've just described. And you found and launched, I guess, Claymore in Canada. Can you describe what was Claymore? How did you decide that was what you were going to do? How did you build it so fast, by the way? And maybe that story around, with Blackstone acquiring it and all that.
Yeah, it's a really amazing story in retrospect. At the time, had no clue what I was doing. So the big catalyst for me was, at that moment when I realized that I didn't want to be a banker for life, I kind of said to myself, okay, well, I've got till 30. I'm 25. I've got 5 more years. If at the age of 30, I'm still here, I'm going to resign and do something, but hopefully something comes up before that. And that was sort of the thing that said, okay, I'm still in learning mode. I'm still in, I'm still enjoying what I'm doing, but I got to make sure there's a moment that gets me to focus on my next step. And that moment came, 2004, end of 2004. I was working with a client in the United States. So I'd been focusing in the last year and a half on the asset management space. I've been advising asset management companies on ideas of how to raise funds and money. One of the clients that I was working with was a US firm startup. And I kind of went to them and said, look, like, I think there's an opportunity for you to build your business in Canada. And, we at RBC would love to partner with you. We'll support you in doing so. I put together a business plan for them to basically go through it, but really with an indication or intention that we were going to be partnered with them. And they called me up one day and said, look, I love the idea, but why don't you do it? We'd love you to do it
Yeah.
and we'll back you. And, that was sort of like an interesting kind of moment. And I stopped and I said, that's right. And 30 days later, I resigned. And that was the end of
Nice.
2004, January 1st, 2005, I started Claymore. And the reality was, at the time, I advised them on a business plan. And I said, now that I'm actually running this and building this, that's not the business I want to run.
Yeah. And so what was the business?
The business that I sort of saw as the opportunity, I had been advising Barclays and who used to own the iShares business. And, I was kind of really intrigued by the future of the ETF industry and the indexing business. But I also, at the time, had read a really amazing early research report from a gentleman named Rob Arnott on the concept of what they call fundamental indexing, which was this idea of non-market cap indexing using the fundamental values of a stock but benefiting from indexing principles. And I said, look, this is the future of the business. This is going to be what I think is going to be amazing. And I was really focused on my math principles of, how do you optimize to what I thought the job to be done of an asset management firm was beat the markets. Like, how do you build a money manager that's ultimately geared and structured to beat the markets? So, what I focused on was one, efficiency of strategy, low costs. I'm a big believer in indexing. However, I never liked the market cap indexes because they're structurally flawed. And, so I love the fundamental index approach and the idea of like then taking the human nature out of the sort of equation and really focusing on discipline. And this isn't to say that active money management is bad. It was more that I was structuring this mathematically to give me the best advantage to actually outperform. And my view was if you can slightly do this compounding year after year after year, after 3, 5 years, you're going to be a top quartile money manager. And that's how ultimately you build a firm is going to outperform the markets. And so I started the firm. It was a grind. But ultimately I actually found some early success. It was, telling people about ETFs. At the time, there were 11 ETFs on the Toronto Stock Exchange, all run by iShares.
Right.
Actually, back then they were called units, if you recall, and no one knew what an ETF was. Like, they were really used, some institutional clients, some early adopter DIY, and some early adopter, advisors were using them. But I was going out there and telling people why ETFs were the future, and I remember, I'd go talk to advisors, and I'd always ask them, "How many, of you use ETFs?" And in 2006, 2005, 2007, 1 out of 10 would say, "I know I use an ETF." Today, of course, it's 100%,
Right.
the big catalyst was for me, was 2008. And the reason why it grew so aggressively, look, we had a really great story. We had a great business. We had a great product suite. We were innovating. We were doing some amazing things. We were driving the market forward and we were winning, in a meaningful way. But what happened in '08 was, this was the moment when Canadians started to get fearful and as you know, when they're fearful, they make decisions. And, when they're not fearful, they don't make decisions. Or, you don't ask questions. How much am I paying for money management? How much am I, getting in return? How much better I could I have been doing? But when you're losing money, like they were in '08, they were actually asking these questions. How much am I paying to lose money? How much am I ultimately, could I be doing better? And, they of course, moved and, we were a big winner of that. But then in '09, when people came back in the market, they went to GICs, they did things, they made decisions irrationally to go out of the market. When they came back in, our business took off. We 4x'd. So
Right.
I grew to $1 billion at the end of '08. We were the only firm in Canada that actually saw net positive sales in September and October of '08. And then in 2009, we went from 1 billion to 4 billion. And then it just momentum was really amazing. And, 2010, 2011, we went to 5.7 and then 6.8. And then the 2 months from the time that we announced the deal with BlackRock to the closing, it went from 6.7 to 11, sorry, to 8 billion, which was a unbelievable momentum.
Right.
And it was exciting.
I mean, it's easy to say now or look back now because, as you say, there's more ETFs than there are stocks, and everyone's investing in ETFs, exchange traded funds. Like this 8 billion potentially could have become a trillion, but you decided, and you've done a whole bunch of other things that have been super successful. But you decided at that point to sell. What was that decision point as opposed to wow, that this is going great. Why don't we hold on for get to the 16 billion and then 32, et cetera.
So there's no one in the world that would have wanted that to happen and be true. The reality is when I was 28, I started the company and I had a partner in the US that gave me capital. I didn't get to control the company as a result of that, but
Uh,
they went through lots of challenges and they actually, my partners actually switched. So my ultimate partner was a firm called Guggenheim, and, we both, ran the business. I ran the business in a really amazing way, but there was a moment where I was trying to buy them out, and reality was is that, the business just kept growing to the point where they really wanted liquidity, and, it was sort of a decision. The challenge was is that the price that, BlackRock was willing to pay was just well above what I think it made sense to buy it at.
right.
And it was a moment that, ultimately, made a lot of sense to ultimately sell it. It was really difficult for me personally. It was a sore moment. I had a real chip on my shoulder because of the sort of, you can imagine there's a lot of depth behind a lot of the conversations, a lot of the work that went through this. Did a lot for 2 years to try to buy out my partners. And in the end of the day, though, it was a gift in many ways too, because, I built that business. I was very proud of it. I think Claymore was an unbelievable company, but I had already in the last, 18 months started to see where the flaws in my call it business plan were and were very focused on where the future was going. And what the gift was that I didn't know at the time was that it gave me a blank piece of paper to start again and to do it
Right.
differently and better, with all the knowledge and foundations that I had now built for 7 years of building that company.
Okay, so you've got the segue right there. So I don't know where Wealthsimple comes in this sort of timeline here, but I think it was Claymore and then Purpose was sort of we met when you were starting Purpose. So maybe you want to talk about that. You sell Claymore, you've got your lessons, and you know what you want to do, and you What were you then trying to build that time, and what does purpose look like now?
So first is to kind of give the origination story. When I talked about Claymore, remember I thought my job to be done was as an asset management firm was to beat the markets. And frankly, that's what I optimized for. And I'm very proud that we did some amazing things. So just to give you an example, the very first ETF I launched, the Canadian Fundamental Index, it of course when it hit its 5-year number, it was not the number 3, number 4. It was the number 1 Canadian equity fund in Canada. It beat every single Canadian index, every single Canadian active money manager. It did amazing. Now,
Wow.
that was, through 2008. And, I'm very proud of that, that we built these products that were ultimately gonna be top quartile or top decile in that case, number 1. The reality was that our investor flows, the decisions of our investors didn't mimic the return. If an investor had bought the fund on the very first day and so held it to the 5th year, then
Yeah.
yes, they would have gotten that return. But the reality was people were buying it all through 2005, 2006, 2007. And then in '08, there were people who were selling it. And then in 2009, they were buying it. And the reality of the investor decision was different than the actual fund. And what I said was, it doesn't matter if I build the best investment products in the world if my clients don't use it effectively. If they
Right.
don't know how to ultimately stay invested through both good and bad times, then ultimately it's not adding value to the marketplace. So I said, I've got to change that. So we built purpose with one starting a foundation of let's build similar concepts of keep costs low, compound, long-term accrued value, keep, use the best and most modern ways to invest, both active and passive principles. But what we focused on was how do we deliver more outcome oriented, more purposeful structure outcomes as opposed to just returns to beat the markets. Frankly, I believe that no, most people don't really care what the S&P 500 does in a year, but what they do care about is their goals. And the principle of when I looked at the wealth industry and the asset management industry, they're so critically important to each other. They work so symbiotically, they're supposed to be. However, they don't talk to each other well. The asset management industry is telling them how we're going to beat the markets, and the wealth industry is saying, I just want to solve clients' outcomes. And so our goal was how do we build investment products that allow advisors to build more resilient, structured portfolios, just like you would if you were building a sports team, right? You wouldn't put 5 Sidney Crosbys on a team to win a championship. You have to build people who have very specific purposeful roles, and same with investment strategies. And so we built that. At the same time, though, I had a bigger vision from the start on asset and wealth, and I wanted to help really modernize the wealth industry. And so, in fact, I had a whole principle of the future of how technology infrastructure, how, the principles of understanding service level offering to an individual who has $5,000 all the way to someone who has $50 million could ultimately be structured on top of a really modern way of building the practice of wealth. And, we had sort of built this principle and we were going to go and pursue that. And, that was broken up into 3 different pieces, a ultra high net worth platform support model, a advisor platform support model, and then a call it early stage investor, call it support model. The interesting thing was, so I was kind of actively working on, so about a year into the business, 2013, a year into the business, 2014, I had been, kind of working forward on, let's go build this call it early stage technology platform. And I got introduced at the time to a friend of mine, through a friend of mine to Michael Katchi. He said, yeah, I know this young guy who just came back from the Valley. He wants to do the same thing. You should meet with him. So Mike comes in the office and he and I sit down. And Mike is my co-founder with Wealthsimple.
Yeah.
And the 2 of us are chatting about, Mike wants to do this, I wanna do this. I said, "Look, Mike, we both wanna do this. Why don't we do this together?" And that was ultimately the starting point. A week later, the 2 of us agreed to terms on a partnership, and we created Wealthsimple from there. And, I couldn't be more proud of the business that we've created there. The principles of it were very simple. I believe that our industry has failed a large part of the broad investor community because it has ignored smaller investors, early stage, or individuals who have less than half a million bucks because it's based on average economics. Our technology, our infrastructure, our services, everything are based on this concept of average economics. And what it assumes is someone who is larger makes you good, well, returns and profits. And someone who's smaller is very hard to make profits from. So they ignore the smaller end or they treat them like crap. And my principle was let's go and build the systems that are based on unit economics of how you can operationalize and structure at scale how to run money for someone who has $3,000 and upwards, and then build the service level on top of that of what those customers need at different moments in the journey of the customer. And that was the principles of what Wealthsimple was all about. And today, that business is now grown to over 3.5 million Canadians. It's servicing over 55 billion in assets in Canada. And, it's unbelievable what it's doing. And, I will tell you in the next decade, I believe Wealthsimple will become the most important challenger to the Canadian big six banks that has ever been seen. And I'm excited about the vision of what Michael has done with the team and executing on that business.
Yeah, it's amazing. And yeah, so it's well known. You're a co-founder of Wealthsimple, but you've been actually in some ways the face of the wealth management industry in Canada in a variety of roles. But you don't seem to be tied too closely to Wealthsimple on a day-to-day basis. Are you actively involved there? Are you just a core investor? Obviously, Michael is, I guess, the face of the firm at this.
My role has changed dramatically, but one of the things that was very important about to me at the beginning was I had a bit of a brand already and Michael didn't. He was 26 years old. If we had ever made this about Som and Michael, then it would have become about Som at that
Right,
stage.
right,
And I wanted Michael to have his own wings and build his own position and voice. And I could tell you that, like, I think he has built an unbelievable voice in the market and a position.
yeah,
I'm very proud of what he's done. And, my role at Wealthsimple has adapted and changed dramatically over the last decade, from early stage, with working with alongside of them to kind of help them with the business plan and strategy all the way to now being a really strong advisor to the company and I'm on the board, and really focused on helping and supporting them on the next part of their journey. And, to me, I'm the biggest champion.
good. Well, it looks like a huge success, and I can see it's really growing. I was speaking with Paul Desmarais III a few weeks ago, who's also a big investor in Wealthsimple, and he was giving me some indication of just how quickly Wealthsimple is growing, and the economics and whatever. And it's yeah, not for me to repeat, but very, very exciting. So,
Well, it's
congrats
amazing.
on
And
that.
I'll just say one thing is, so Paul, PD3 is one of my very dear friends. And it was actually over a lunch that Paul and I were chatting. And I said, Paul, you got to meet this group. And we walked over to the offices and I introduced him to the team. I said, what they're doing is pretty amazing. And we had been contemplating at the time some capital investment from some large strategic investors. And, I told Paul that, like, we should be working with you guys instead. And that was
Right.
the catalyst for, structuring a really amazing partnership transaction that I think formed an unbelievable opportunity and really helped Simple scale, need the capital it needed to kind of build its position early on, but more importantly, also, really help Paul and Power in a meaningful way to build their position and innovation kind of agenda that they've kind of gone off and done some amazing things around. So really, really amazing kind of win-win partnership across everything that we've done. And I think everyone is extremely proud of the relationship that was built between Power and Wealthsimple.
Yeah, that looks great. Let's switch gears a little bit. Let's talk a little bit about digital assets. So, sometimes you're allowed to talk about digital assets because they're hot, and other times no one wants to talk about them. And now, as I saw, I think on X or somewhere, we're back, baby. Obviously, with Trump and maybe Gary Gensler is not going to be around for too much longer as chair of the SEC. Digital assets, Bitcoin, Ethereum, etc., not super easy to get exposure to, and especially, through your advisor and whatnot, regulated like crazy. And you were the first person or first firm to launch Bitcoin ETF and then Ethereum ETF, and that sort of reverberated around the world. And that could not have been easy. Can you just describe, first of all, why did you do that? How did you do that? And what's your view and thesis on digital assets or maybe Bitcoin specifically? This could be a good case study on how to work with regulators to get something really, really, really hard done.
So there's a lot to unpack there. We could talk for hours on it,
Yeah,
but I will
sorry, I
say,
asked like 8 questions in a
yeah,
bunch.
I, I'll start with the why. I mean, so I'm a person that I believe in always thinking about what's next, where is it going, how's the future. I'm trying to build a mental model of the future. When I first heard about Bitcoin and stuff, I was kind of a little bit skeptical like others. 2015, I would, talk negatively and say, like, I think this is like, a fad or a scam or whatever it be. And then I kind of realized that actually people were listening to my words. And so I should go and actually spend some time digging in and understanding what this is all about. And I spent the next year really trying to educate myself. I made an investment in a backing a company that was in the space just to say, like, that's the best way to learn. I mean, I just always find that making an investment teaches you a ton.
Yeah.
The founder of that company, a guy named Ben Roberts, was just an unbelievably young individual who, just taught me a ton. I would be, riding home on my bike at nighttime and calling him and for 30 minutes just grilling him on all these different components of, like, the space, and I just found it really fascinating, and it was really important to me because when and specifically, I'll talk about Bitcoin in a second, but my first love came to Ethereum. And the reason was that, Ethereum has this unbelievable non-linearity to its opportunity, the system that it's building, and specifically around the smart contract structure and the protocol that it ultimately allows for, so much tokenization of things that could be really done. Whereas Bitcoin is a really amazing for it's a single token that basically allows for a medium exchange, value ultimately between one party and a trustless another party in a trustless environment. Ethereum was all about how can you create multimodal kind of principles of exchange and then ultimately allow for tokenization of anything. And what was really critical for me was I was finding a blocker in the fintech innovation space because everything that was happening in fintech was really amazing on the cosmetic front end of the experience, but it was falling into a trap of hitting a wall on the infrastructure. And when I first heard about this, I said, look, this could be the thing that closes the gap, that actually gets rid of the need for the why is everything still clear through JP Morgan Chase on the payment side? Why do we still work with payments principles? Why do we have a bank infrastructure on everything that happens? Like all of this, you can't really innovate if you can't get rid of that. But at the time, it was so early. And so I said, this is going to be an amazing asymmetric bet. It has, the worst case scenario is I'm going to lose my money, but the best case is it has a 10, 50, 100,000, 10,000, whatever upside if they get it right. And they had to solve for three things. One was, governance, which I think Ethereum did really well, security, which Ethereum did really well, and then scalability. And scalability was the big question. Could it ultimately be a platform that could change and execute billions and billions of transactions in an efficient way? So I said, let's go on that journey. So the first thing I actually did was I put together a group of partners that I found were going to be all, both crypto natives, financial experts, and just really great partners. And we created something called Ether Capital. And we launched that in 2018. We went public with the idea with let's just own a whole bunch of Ether and go on this journey of learning about how this is going to play. Um, and then that informed us a ton about, what was happening, and it was the first real way for people to buy in a safe and secure way, the Ethereum, native token Ether. And then in 2020, the team and I had been working on we wanted to ultimately launch a coin and crypto ETF, but what was happening was the change in infrastructure was happening, whereas when we launched Ether Capital, we had to self-custody everything. I mean, ultimately, when we turned the thing into an ETF in 2014, just this year, we was, up until that point
2024.
yeah, sorry, 2024. Thank you, sorry.
Yeah.
When we turned it into an ETF, it was like we were still self-custodying as a board the asset. We had a multimodal, we had to worry about security, all that stuff ourselves.
Yep.
Somewhere in about 2019, 2020, the world changed on the infrastructure side, where custodians came to the market with a really secure and safe way to structure execution for an institutional kind of a product. The market for trading and efficiency of futures and things like that changed. So we went and worked with the regulators. It took us 9 months. And our message was this is the most safe and secure way to ultimately build and have investors have access to it. Whether someone should buy it or not buy it is another question. But our view was, all the scams, all the things that you were worried about, an ETF is the most safe and secure way to do it. And we ultimately convinced them and allowed us to launch the first Bitcoin ETF and then subsequently a couple months later, the first Ether ETF in the world. And we're very proud of that because the infrastructure we built has now reverberated around the world. And now ETFs are ubiquitous around the world, in the United States, most notably recently. And it's a large part of the infrastructure that we built here in Canada that allowed for those things to ultimately come to fruition. So I'm really excited about it. And I do have a deep thesis on the space. I'm happy to talk about Bitcoin as well, which
Yeah,
is a
we'd love
different.
to we'd love to get a little bit more thoughts on, yeah, what's your thesis? What's your long-term view? And do you, because with Purpose, you have an advisor group there that, many advisor groups that advise clients. Do you have a general view as to what percentage of a portfolio might be appropriate for a client to have in Bitcoin, Ethereum, something else? Yeah, I would love to hear a little bit about that.
So first off, I would just say that these assets are really today very different than they were 3 years ago, even 5 years ago. When I started getting involved 6, 7 years ago, it was still it could go to zero.
Yeah,
Today, they're not going to zero anymore, and that's a really important thing. So there's still a lot of prognosticators out there who say, "Oh, Bitcoin's worthless," or these assets are worthless. But I think that that's actually a historic perspective that is wrong. Um, what's fascinating about Bitcoin is a very different. So I'm a big Ether fan. I love Ether because I love the technology, the infrastructure, and the potential of what it can be from a system structure perspective and innovation perspective. Bitcoin is a very different thing. Bitcoin is actually a very linear concept, and it's actually really a social experiment. And as sad as that sounds, it is a fascinating one. A lot of us did not get to witness and watch the 3,000 years of formation of value of what gold is as a foundational asset. And, we didn't get to see that. We just know that gold is worth something and people are willing to exchange value for it. Bitcoin, in effectively 16 years, is going through that same principle in front of us. And so for a lot of people, it's hard. It's hard to think non-linearly about that. But it is a truly fascinating social experiment. There's a set number of tokens out in the world that could ever be in existence. And there is a lot of people that ultimately want to own it or not own it. It's all a supply and demand fundamental principle. And that's how you ultimately say, is it worth something? And that's also why I don't believe it'll ever go back to zero, because there's enough people always who will say it's worth something. I don't know what it'll be worth in the future, if it'll be worth $100,000 or $100 million, or sorry, $1 million or $5,000. But I do know very clearly that more and more people are going to find this as a very important stage of medium. And, the volatility of it over time will ultimately become more like a currency, like gold or anything like that. It's just because it's forming and going from a fringe asset to a core asset, it's got this high volatility of, future expectation of value. So, that's an important principle. So, from an investor's perspective, my belief has always been that I think every investor should have, and I say every because, with an asterisk, there's always, some people who just don't need to have exposure to it. But ultimately, most investors should have zero point 0.5 to 1% of their portfolio in crypto. I don't understand why someone wouldn't have that kind of exposure.
right.
Um, it's a critical foundational thing depending on the future of the state. And I'm a big believer in this kind of concept of get off zero. If you have nothing, have something and then participate in one way. And that's the kind of way that I think about advisor utilization, investor utilization in their portfolios.
Nice. Yeah. No, I think that makes sense. And when you say, have something, 0.5, 1%, whatever it is, and obviously, you've launched the ETFs for this, but in a perfect world, are those folks getting exposure through ETFs, or are they holding these currencies somehow themselves? And I say somehow because it's on the one hand, it's easy. On the other hand, it could be more complicated. What would you recommend?
So, first and foremost, I think that most investors, I mean, want to use them in their normal portfolios. So, brokerage accounts, things like that, investor accounts are, ETFs are the best and most efficient way to do it. So, there are people who will open up a separate account, go to Wealthsimple or whatever it be, and buy their crypto that way. And we actually have found that, like, a lot of young people and also high net worth people wanna have direct exposure to it, and their advisor may not ultimately want to buy it for them, so they'll go and open up an account, either a DIY account or an account at one of the, crypto firms. And frankly, my view is, all these you wanna make sure you're in a legit place, but the beautiful principle about ETFs is they're the most safe and secure way. They're custody, they're structured in a really great way. So for most investors, I'd say the largest cohort of investors, they're going to use ETFs, in my opinion, as a core way to ultimately access the market. There'll always be some small group of native people who will go and own the directly on the, they'll go buy it with their ledger wallets and
Yeah.
actually do it. But those are, people who really are sophisticated and understand how to do it because there's
Yeah.
so much risk fraught in, the principle of self. It's like kind of like if you remember the old bearer bonds, it's like, you own the asset and if you lose them, they're gone. Like, so, the beautiful thing about ETFs and, kind of working with a firm is that you can actually have them custodied in a great way. So
My best friend called me this morning, lives in Detroit. I don't know if he listens to the podcast, but Todd, if you're listening, I'm talking about you. And he said, my crypto is now getting a little bit large that may be keeping it on. And he named an exchange. I won't say which one it is, but it was a totally fine one. He said, and I got him a gift of a ledger, him and his son, to get sort of to understand this technology. But, with me guiding him through the whole process, they still struggled a bit to deal with this hard wallet. So my point is, it's hard. Like
Yeah.
it's hard to do this on your own. You make a mistake, you forget your seed phrase, or you lose your wallet. You could lose all your assets. There's a reason why
Yeah.
there's banks.
Well, when we launched Ether Capital, we had 45 million of ETH. We had it again in our ledgers, and we would do transactions with our ledgers with the board and everything like that.
Right.
When at the end of it, we had 250 million of ETH. So you can
Yeah.
imagine the amount of value that was like created, but also you're sitting there every day, you're trying to like, oh shoot, I really hope I don't make a mistake on this, like this transaction. Now we had a lot of structure around it because we had, seven, board members had to make decisions on every single transaction and things like that. But the point was, it was really scary sometimes when you're thinking about, am I making a mistake ultimately with this transaction? And you controlled that decision, right? Whereas we lose that perspective in the normal capital market. You trade a stock. If a trade goes wrong, you can always reverse a trade. You can do these things like that. But
Yeah.
in there's so much system structure there. But in crypto, it is, that system has to ultimately be built still on top of it. The
Yeah.
controls.
Yeah, it's hard. Really appreciate that detail. Okay, so talked a lot about some of the innovations that you've brought to market and have done. I don't want to keep telling you what you've done. Is there anything that you're super proud of that we haven't talked about that might be interesting to mention?
Look, my most, I mean, I've done some amazing things I'm really proud of, through the years, but the thing that I'm, most proud of, is our longevity pension fund. This was something that was really important to me. When I started Purpose, I said, look, we're going to solve for, the industry continued accumulation phase of like how to give people good investment portfolios. But I also want to solve for the decumulation phase, the period of like retirement when someone goes from, saving and, kind of all the rest of it to ultimately, I need to have the portfolio generate the income to live my life off of. How do I ultimately structure that? And different people have different goals, but the foundational principle was, how do I have enough for as long as I'm going to live? And, as we moved away from DB pension plans, in the 80s, 90s, and 2000s, most Canadians today are not covered under a DB pension plan unless you work for the government.
DB being
Defined benefit. So that means that you work for a company. The bargain is you work for a company. They basically take a portion of your salary, put it into a savings. They match that, and they basically manage that on an institutional grade. And then once you retire, they will now give you a stream of income for the rest of your life, no matter how long you live. And that is the DB pension plan. It's a really powerful accumulation and decumulation bargain. And in fact, was the reason why many people stuck with the companies that they were.
right.
When that bargain shifted and companies didn't want to take the liability of giving income for life anymore, they moved to what they call defined contribution plans, which is just a savings plan. It's just an investment portfolio savings plan that the company ultimately is organized for you. And so there's no lifetime income. There's no kind of plan for, once you retire, it's kind of your responsibility. And so most Canadians today have the responsibility of retirement has gone from the corporate responsibility relationship to an individual responsibility. And as a result of that, most Canadians don't have the benefit of a structured pension, but most importantly, a structured income stream that is matched to the term of their life. And I saw all this opportunity to really help change that. We innovated this product. We were the first in the world to do something like this, which was basically build a pension solution, income for life solution in a structure of a mutual fund. And the reason why we did it in that is that the mutual fund is so beautiful because it allows for everybody to have access to it. And we launched that 3 years ago. And I can tell you, like globally, the conversations I have with firms around the world about what we've done here in Canada, it is amazing. And the pension community on a global basis. And so, I'd love to see that really go to another level, and really help Canadians really have confidence post work. How do I know post work that I'm going to have enough no matter how long I live is a really critical thing that I've really focused on.
Yeah. That's awesome. Maybe last question on the industry because you've done so many different things, and maybe your answer will be something you've already done, but you have a real amazing view of what's happening today and where the industry and where the future is going. If I said to you, okay, Sam, I'm taking away everything you have right now, all your businesses, everything you've launched, everything you've done, but you get to start a new company today. You can have one product and that product you will, launch and run, and that's going to be how you generate your income for the rest of your life.
So I don't think that it's that different than what the problem to solve today is. I think that a planning based service to Canadians to help them ultimately achieve their goals is still the most important call it intermediary value that can be given to any Canadian. And so a wealth firm, a wealth advisor that ultimately can help Canadians succeed, not just by, hey, I'm going to give you better access to the markets, but I'm actually going to help you achieve your goals and ensure that you have your liabilities met and really be focused on everything from your estate to your taxes and ultimately your portfolio.
Sounds like a business I'm familiar with
That's
over
right.
here.
And now there's a large part of that can be done in an effective if infrastructure, technology, operational, and call it marketing and principle of telling the story in a great way, which I would be really excited about. But I think that that's the innovation that can be done in that and really being focused on how do you tell that story to Canadians? How do you help them? How do you build the systems around reporting and structure around really doing that in a wonderful, delightful way? How do you get the experience on the back end and the infrastructure? That could be really amazing. But ultimately, that's the service that what financial services is here for. And what we're all here, that's a job that we need to do. And it's all about how do we do that better and better and better and better. And so that's the one problem to solve continuously. And it never ends until everyone is solved.
Right. Beauty. Love it. Okay, last question. Again, we've reviewed all your career and what you've achieved. Is there like a single key lesson you might have for folks, whether they're early in their career, whether they're in the middle, wherever they are, that if you had one piece of advice, you'd say this advice, this will help you really achieve in life, whatever achieve means, doesn't necessarily mean money, but, or success at work. But, what's your piece of advice to listeners?
Yeah. So first off, like I think my whole life I've been chasing or running away from complacency. It's something that really is important to me. I've always focused on this idea of how can I always get better, improve, be somewhat unidentifiable every 2 years, like meaning like someone sees me and says like, wow, like how much you've grown and changed. And so
Right.
that's a really important thing. And I think I tell everybody is compound your growth, compound your constant learnings on a day-to-day basis. And my biggest thing is don't fear failure in life, fear average. That's the thing that we all should be focused on is the worst thing in life is just to be average, be something better than that. And I think too many people will be settled for average because they're afraid to fail. And
Right.
that's just not the way I've ever lived my life.
That's amazing. What a great way to end. So listen, Som, thanks for your time. I really appreciate it. Thanks for the reschedule for my voice here. You're doing amazing things. We use some of your products, as you may or may not know, for our clients. So we appreciate that. And yeah, just all the best and thank you. Enjoy the holidays and look forward to seeing you soon.
Great to see you, Brian. It was a wonderful conversation. Thanks for having me on.
The Unlimited podcast is hosted and produced by Brian Ginsler and is edited and mixed by myself, David McMillan. This podcast is not to be taken as investment advice. If you like what you heard, don't forget to rate the podcast and follow us on social media at Ginsler Wealth. Thanks for listening and see you next time.